Welcome. Today is Thursday, December 11th, and we're toward the end of the day again. But this is still going out. I'm gonna be consistent. This is Jeff Wright with Fish Creek Capital. Thanks for watching. We just want to go over the um, market news today, and then we're going to talk about how to analyze a dividend stock in under 5 minutes. It's going to be high level, can quickly show you how to go through some tools that I like looking at, and we're going to do WD-40 as our company. So stick with me for that. First of all, let's go back to the news and see what happened today. The futures were down a lot on Wednesday evening, like down a whole lot. That was after the Fed, the meeting yesterday. Jay Powell came out, they cut rates, and the market went up. And then overnight, the futures were down a lot, like a ton. And then we ended up having a good day. The Dow was up 600 points. The interesting thing to note is the equal weighted S&P is catching up with just the regular S&P. So the S&P is a weighted index. And so the last few years, you hear about the Fab 7. Those are the big tech stocks: Amazon, Apple, Google, NVIDIA. Those are the ones that have been kind of driving Microsoft. Those are the ones that have kind of been driving the returns in the S&P 500. And the equal weight, when you take the S&P 500 from an equal weight perspective, it's underperformed, because then it's just not, so heavily weighted on like six stocks, right? Well, so the last month, probably the equally weighted S&P is actually catching up. You can track that. RSP is an index that you can track. That's the ticker symbol RSP. That's one that you can watch and look at compare it. That's a good way to follow that. But let's see, the equal weighted S&P was actually up over 1% today. And then the NASDAQ was down most of the day. Let's get the official numbers. Yeah, it was down 0.26%. And then the actual Dow was up 1.34%. The Russell's up 1.21%. So that's kind of an interesting shift. You're seeing a rotation out of these big technology names. And a lot of this was under the premises of Oracle's earnings. They came out yesterday after the close, and there's a lot of speculation on or concern about the free cash flow that Oracle said they were going to put toward the AI, initiatives that they are doing. And there's a lot there. There were some concerns from their conference call that might not be able to be fulfilled. And so that was kind of driving the NASDAQ lower. So that was kind of the big news today. The other big thing I want to remind you quickly too, that was important out of yesterday's Fed meeting, was the fact that they're going to purchase $40 billion of treasuries per month to provide liquidity. And generally that's good for the markets. We'll see how long it takes for that to kick in. It can be especially good for things like crypto, and crypto has struggled, and a lot of people have moved on from that. It is a very volatile, very risky asset. People either seem to love it or hate it. But if the Fed is talking about buying $40 billion of treasuries per month, and that was not, I don't know that it wasn't expected, but it was news yesterday during the announcement. And so that could really help out the market even into next year. So it'll be interesting to see what happens with that. Okay, let's look at WD-40 from a dividend perspective real quickly, and I'll just kind of go over it and show you how you can analyze a dividend stock. I'm going to share my screen. All right, so the WD40 is the ticker is WDFC, and the reason I was going to do WD40 as an example was because they had a news article out this morning that they're raising their dividend by 8.5% to $1, right over $1 per share. So that sounds like a lot. It caught my eye, and dividends are what we focus on at Fish Creek Capital, especially growing dividends. And so I just wanted to look at it with you so you can see kind of what WD-40 looks like. WD-40, of course, they are known for their spray and cleaner, mechanical cleaner. Let's see what else it says here that they do. They develop and sell products that solve problems in workshops, factories, and homes around the world. So that makes perfect sense. They do have other brands. The Lava, that's the soap that cleans your hand when you clean your hands when you've been working on a car and you got grease all over your hands. That stuff actually works pretty good. So they do just have products outside of WD-40 that are maintenance products, home care, all based around cleaning. And so they have raised their dividend by 8.5%. So that's very positive. So again, Seeking Alpha is a tool that I like to use, just seekingalpha.com. Let's look at what they show about their dividends. So they pretty good scores here. Now their yield is not looking good. I think it's a 2% yield. Let's go back over here to CNBC, and you can always scroll down on CNBC and see the metrics for a company. So they're showing right over 2% yield on WD-40. So that's not the greatest yield, but not the worst either. Often when you're looking at a dividend, you want to see how the yield compares to the growth of the company. So that'll be interesting. Let's look for that in a second. But if they've got a real high dividend, generally that means they don't have a lot of growth. Not always, but that's kind of the rule of thumb. If you've got a lower dividend, then you'll tend to see a lot more growth on the earnings side. So that explains, I think, the D there. They've got a payout ratio of 64%. We like to try to stay below 50% on that. So that's kind of on the high end. Here they're showing a 5% growth rate of 7% on their dividend. So that's not bad. They're showing dividend growth of 15 years. That's pretty good. Let's look over here on the history. Their grades are pretty good grades. 35 years of dividend payments. So that's pretty strong. And again, 15 years of growth. So let's see what else is going on here. So again, their payout ratio is kind of high. Let's go back to this scorecard. Okay, we got a lot of red here. So this is not that great. So we're looking dividend yield for the trailing 12 months is 1.95%. Not the best. There's earnings yield is not looking that great. Their free cash flow, that's important for dividends. That has a pretty low score. It's below their sector average. Let's go back over here to the dividend growth tab. And again, all this is on Seeking Alpha. So they do have, we'll try to look at 10 years of dividend growth. What does it show the growth rate is for 10 years? So they're showing 9.48%. That's pretty good, really. Okay, so all right. So what have we learned from Seeking Alpha? So their payout ratio is sort of high. Their dividend is 2%, so it's not the greatest. We want to see what they have on their earnings growth to kind of grade that yield. they've paid a dividend for 35 years, and they just increased it 8%. So those are all positive things. But let's look. It's a WD-40 is a $200 stock, and let's look back too on CNBC. The other thing, it has not performed well this year. It is, let's see, let's scroll down. Yeah, year to date, minus 17%. So it's done terrible this year, frankly. It's done well in the last 5 days, but year to date is minus 17%. 1 year, minus 25%. So it's definitely underperformed. So there's something going on there. So the other tool I like is Fast Graphs. You've heard me talk about that. There's actually a link in the description below to where you can sign up for Fast Graphs if you want to use it yourselves. That is an affiliate link. Here, WD-40. Let's click back. Let me refresh this. Yeah, so it's kind of expensive. That's what I figured. I knew, and I had kind of looked at this too before got on here. But like, I was surprised how expensive it was, though, as far as the stock. And again, price matters. If you know what something's worth, then you know what to pay for it. That's why I like these tools like Seeking Alpha, like Fast Graphs, because if you can figure out what a company's worth, then you really know what to pay for it, because it really does matter on what your long-term return is going to look like. So it's real important. Price is important. So they're up above, remember, so like what we've talked about before, the blue line is the normal PE ratio. The orange line down here is the fair value. And then the green here is going to capture the growth rate. So like we are up above, right along the normal PE ratio. Now you can see that it has tracked that blue line and actually stayed above it since 2016, 2015. So that's strong. Looks like it was really doing well in 2021. It was priced, PE was up to 70. That was really high. And like that, just for the point of why price matters, if you would have bought this in 2021 and say you went back out to the normal PE ratio, you would have had a negative annual return, total return negative 25%. And that kind of actually matches if we come back over here and look on the 1 year return, we're minus 25%. So that's why, all this stuff kind of starts lining up, which is really cool. And it can give you confidence in the investments that you're making. So yeah, see, like that's why price matters. Now, if you would have bought it down here, let's say in 2018, back on the blue normal PE ratio line, according to Fast Graphs, and track that out, you'd be still a low return, 6%, but it wasn't negative 25%, right? So, and that would have been with around a 29 PE, which is back to the average, so price does matter. So we're overpriced on this right now. So I would say, like with the high payout ratio, the growth is what, let's check this growth. So they've got a 4.5% growth rate. Like we really want to try to look for over a 10% growth rate when it comes to earnings. And the fair value of the stock price, again, according to Fast Graphs, is $100. Current price is $200. So again, at this price, it's just, they're showing based on the forecasting that it would have a negative return. So again, I think we're past our 5 minutes, but you can start digging into this data. I love doing that. That's what we do here at Fish Creek Capital. We're looking at individual companies. We're figuring out what they're worth. We're especially focusing on growth and dividends, and especially the growth of that dividend and how that company is distributing their free cash flow to create portfolios for people that just build confidence and will generate income, cash flow over the long term, especially during retirement. I don't like WD-40. Again, this is educational purposes only, not investment advice. Please do your own research. But this doesn't, I'd pass on this one, even with the great, what looked like a great headline, 8% growth on their dividend. I don't like it. I think it's too expensive. I think there's a lot better choices out there. So there's a quick look at WD-40. I'd love to help you look at your portfolio. If you need help looking at that, please like and subscribe on the channel. I'm doing a video every day, and just so I can get better at this and give you information that's helpful around dividends and market news. So please like and subscribe for that, and go to fishcreekcapital.com, click on learn more, and you can reach me that way. I would love to talk with you. Also, in the link below, you can schedule a free introductory call with me, with Fish Creek Capital, and we can go over your portfolio, and I can help you with that if you need help. So please do that with the link below. Thank you for watching. We'll catch you tomorrow.